Jide, it's great to have you on the show, and I want to first of all get your perspective on the flurry of banking results we've seen recently. Your thoughts on how that's impacting how you're allocating assets right now.
Good morning, Wole. We've seen quite a number of results from the banks. I think about 60% of the results have come in already. And the good news is that they are broadly in line with expectation. We haven't seen any surprises from any of the banks. Rather, if anything could be said to be a surprise, it will be an upside surprise in terms of performance that have been slightly ahead of expectation, especially from the top tier banks. Broadly speaking, with respect to our asset allocation, it's more or less remained as it is. We haven't necessarily aggressively restructured our portfolio just because of these results, because we had positioned ahead of time in the preferable names to us, and then we are just sitting in right now and just enjoying the benefits of the results that have come in so far.
All right, but for somebody coming into the market, maybe trying to increase allocation to equities in particular, how would you advise they play the banking sector? Some are suggesting that following the MPC decision, there's some pressure there, and it's probably safer to stay with the top tier large names.
Absolutely, I agree with that. I think it's a sentiment that we've been expressing since the beginning of the year, following from what we have seen in terms of reforms in the banking sector, and how it has affected the industry as a whole. With respect to the MPC, we expect that these moves of increasing the CRR from 8 to 12%, as well as reducing the net open position from 3 to 1%, would significantly affect the bank's balance sheet. There's no doubt about that. In terms of loan growth, we expect that in view of the curtailment of liquidity from the CRR increase, it would slightly affect the ability of banks to disburse loans, and we all know that banks are just trying to resume appetite following the events of 08 and 09.
Right.
So certainly it would affect them. In terms of interest income as well, this is supposed to also increase the cost of funding for the banks as well. So it will certainly affect all of them, but we think that the top tier banks are in a better position to manage this development because they have a more diversified deposit base. They still have access to cheap sources of finance. And in terms of their liquidity ratio as well, most of these banks have liquidity ratio of 60–70%. And so they won't be too constrained in terms of aligning their balance sheet to this MPC development.
All right, okay, so within that space, the top tier names, which will be your preferred picks? We've got the likes of First Bank, GT Bank, UBA. Which would you prefer in that space?
Our preference is still for First Bank, GT Bank, and Zenith. And that's because we've seen those three banks demonstrate a high degree of resilience in their performance. First Bank's result shows that they had a gross earnings of 182 billion and a PBT of 54 billion, which is clearly ahead if you compare it to their full year result, which was for 2011, which was just around 24 billion. The same thing for Zenith Bank as well. The result is also a very strong performance, looking at gross earnings of 151 billion and a PBT of 50 billion. And despite this MPC development, we expect them to be able to sustain that run rate for the second half of the year. So we have preference for First Bank, for GT, and for Zenith, even within the top tier names.
All right, so if we move out of the banking space, we had the likes of Nestle release numbers 2 days ago, Nigerian breweries. What are your thoughts about what we're getting from the manufacturers? And of course, when you also bear in mind the impact that the MPC would have on borrowing costs for such names.
I think for the consumer companies, the development that is mostly affecting them right now has to do with the effect of security concerns in the north especially, and how that is affecting their cost of inputs. Generally, what we see is that there's been a rise in the cost of inputs, and that's because farming activity has kind of reduced, and we're also seeing that effect also in terms of increase in cost of food if you look at the last inflation figures that came out. So that really is where the consumer sectors are feeling the pressure the most. In terms of the cost of funding, perhaps it would increase slightly, but look at the likes of Nestle, Nigerian breweries. They are able to source funds from their parent company, even using dollar-financed facilities rather than much of local borrowing. So we don't think the cost of funding implication is going to be as severe. Right. But they would feel it more in terms of their rising cost of input, and I think that's what we've seen from the results that have come out so far.
All right, so
but
all that,
albeit I would still say those results are still also quite strong performance from the likes of Nigerian breweries and Nestle.
Okay, but all that said, and of course bearing in mind the valuations that we're seeing for the likes of Nestle has hit 500 naira recently. How will you allocate to non-financial names right now? Which stocks are most attractive to you right now?
Within the non-financial, I think our preference the most is for the food and brewery sector. We are overweight in the food and brewery sector, while for petroleum marketing, we are underweight. For consumer, for the cement sector, we are neutral. And the reason is because if you look at those results that have come out for the likes of flour mills, though they underperformed in their last result, we expect that by the time they release their Q1 numbers, we should see some pickup there. And we like the likes of UACN, reason being that the business is a very well diversified one, and you'd see that they are also able to pass on some of the increasing costs that we are talking about. So for the likes of for UACN, for flour mills, even Nestle, well, you would say maybe the valuation is reached at around 500 naira. But the fact is that Nestle is not as liquid, and the stock is not as liquid as that on the market. And so if you look at their result relative to the price valuation, I think Nestle is still a stock that we are comfortable to hold in the long term. From an institutional investor's perspective, maybe we'll take in some profits here and there, but we're still comfortable with those three names especially.